morning, everyone. We are really glad to be here today with you. My name is Savneet Talwar, and I'm a tax director at Andersen. I specialize in U.S. corporate taxes, and I've been working in this field for the past 18 years. Over the course of my career, I've had the opportunity to work with a variety of companies, from large corporations to mid-sized to small. And we've helped them navigate through the complexities of U.S. tax regulations, compliance, as well as strategic planning, especially the cross-border businesses, because most of the Canadian businesses are also in the US. I'm looking forward to sharing my experience with you today and make this session as practical and as easy to understand as possible. I will be leading this training session along with Kristjan, who's a very important part of my team. Kristjan, go ahead.
Hi, everybody. My name is Kristjan Luik. I am a senior manager with Andersen, specializing in U.S. tax for businesses. I've worked in cross-border tax for about 9 years, helping to solve tax issues and reporting requirements for both individuals and businesses. So we're so happy to share our thoughts with you today. I hope that you'll find the content relevant and useful to help you understand and respond to this new tax legislation. If you have any questions at all, Savneet and I are here to help. You can find our email addresses on the slide here. You can feel free to add us on LinkedIn. And yeah, we're very happy to be in touch.
All right, a little bit of housekeeping items here. So the first one is the polling question. So as a NASPA accredited sponsor, we're able to offer CPE credits for this webinar. And in order to qualify, you will have to answer all 3 polling questions that will appear during the session. They will pop up at various times throughout the seminar. So please make sure you stay tuned and respond promptly to each one of them.
So we do encourage you to ask questions throughout the webinar. There is a Q&A button towards the bottom center of your screen. We won't address the questions immediately, but we have set aside 10 minutes at the end of the session to go through as many as we can, and we really appreciate your engagement today.
And of course, there's going to be a survey at the end of the webinar. Please make sure you fill it out. It really helps us improve our future webinars and continue to provide relevant and valuable content to you. Also, if you want to enable the closed captioning, please go to the live transcript button at the bottom of your Zoom window and select Show Subtitle. Especially if you're working in a noisy environment, this could be really helpful. So let's get started. We have a lot to cover here today, don't we, Kristjan?
We do. So we're going to start off discussing a bit of background behind the Big Beautiful Bill, starting with Trump's campaign promises related to tax, and discuss the progression of the bill through Congress and into law. We'll talk about some provisions from the Tax Cuts and Jobs Act, which was the tax reform bill from Trump's first term in 2017. And we'll walk through some of those provisions that are set to expire and those that are being extended by the Big Beautiful Bill. We'll touch on Section 899, which was proposed, but was fortunately for Canadians not signed into law in the end. And lastly, Savneet and I have picked out the areas of this legislation that we feel are the most impactful for our clients. So we'll be explaining some of these changes and the challenges or opportunities that they create from a tax perspective, and discuss how individuals and businesses can respond to these changes.
All righty, let's start talking. But before we dive into the one big beautiful bill, or we, as we say, OBA. So we do find new acronyms in the US tax side. And as we go through the slides, you will see us use a lot of acronyms. And so I think for a starter, I want to talk about TCJA because we'll refer to it quite a bit. So TCJA actually stands for Tax Cuts and Jobs Act. This TCJA Act, or TCJA, because the A stands for Act, it became law in 2017. So this was during the first term of President Trump. And this brought about a lot of sweeping tax changes, and it affected a lot of tax areas, and it affected businesses, individuals, estates, trusts, everything. So this is the second big change in the last 10 years for tax regulations. Yeah, and so moving forward with Tax Cuts and Jobs Act, the important thing to note here was a lot of regulations of TCJA were temporary. So if you look at the slide here, so everything that you see in gray, and I know it's a little bit small to see, but the goal is everything that is in gray was set to expire after 2015. So basically, there were a lot of tax cuts that were made starting 2018. And if they expired in 2018, if they expired in 2025, in 2026, they would go back to the older rates, which would be the higher rates. So it would affect everybody, all individuals, and there'll be less money in everybody's pocket. So it was really important that this OBBA Act, or the One Big Beautiful Act, became law sooner, so that it got some permanency and help all the tax like owners, tax preparers, accountants, as well as the owners of the businesses with their tax calculation for the future or the deferred taxes. Okay, so go ahead, Kristjan.
So on the campaign trail, it was a really big part of Trump's campaign to extend some of the tax benefits that were provided by the TCJA and to introduce some new ones. So some of the popular items that you might recall were no tax on tips, no tax on overtime or Social Security income. Elimination of the SALT cap. So that is the limit of state and local taxes that individuals were able to deduct in the US. He had pledged the extension of 100% bonus depreciation, moving back to expensing research costs instead of capitalizing them. So overall, some of these promises are very expensive to deliver in terms of the foregone tax revenue. And we expected it would be a challenge to get all of these ideas passed through Congress. But in the end, the bill was controversial, but it passed in a quite quick time frame. So the bill passed the House of Representatives by one vote on May of 2025. So the vote was 215 to 214. It passed through the Senate on July 1st, again with one vote, Vice President J.D. Vance being the tie-breaking vote. And it was signed into law by President Trump on July 4th, just like he had intended. So yeah, this was finalized less than 6 months after Trump came into office.
Very interesting, isn't it? So one thing I do want to talk to you about on the slide is that 15% rate solely for domestic manufacturers. I want you to remember this because we're going to talk about it later in our presentation, because this didn't go through, but they found other ways so that domestic manufacturers actually got more as a result of this act. So just moving forward, Kristjan, you already talked about this, like the timeline and how quickly this moved forward. So Trump became the president in January, and now we are in July, and we already have a new act and a new legislation now. Okay, so why don't we dive into the key changes for businesses here? So I think one of the big changes is interest. And interest, so when you deduct interest, there's a limitation called the Section 163J limitation. Basically, it tells you how much you can actually deduct, how much interest you can actually deduct for your taxable income purposes. So what changed here? So this act, the OBBA Act, it permanently reinstated the EBITDA, so earnings before interest, taxes, depreciation, and amortization limitation for calculation of the deduction. And this is this starts with 2025. So again, when you look at this act, some changes are effective 25, while some are effective 26. But the important thing to note here is the limitation of the interest has gone up because now you can take your taxable income. There are other adjustments that you make, but now you get to add back that depreciation and amortization, which increases that limit quite a bit, right? So especially if there are a lot of interest that you've paid, this could be something, especially with Canadian corporations that have US subs and the US subsidiaries are paying interest. cross-border, this could be really, really helpful. Or you have taken loans in the US and now you get to deduct more interest. Isn't that wonderful?
Hmm. So we should see our clients largely getting larger interest deductions moving forward if it was
Exactly.
previously limited by 163J.
Absolutely. But there's always a but. So they've given you this limit, but then they've also said that this limit would not include what was called the guilty. We'll talk about guilty when we get to our international provisions, but this limit will not include the net CFC tested income or the guilty and the 78 gross ups, which is section 78 or subpart F is similar to FAPI in Canada. So that is an important change. The other piece, which is not so great, is earlier there was some regulations where you could capitalize the interest before you consider the limitation. So you could capitalize it and amortize that interest. But now you would have to look at this limitation before the capitalization. Of course, there are exceptions. There are two exceptions to it. But now you got to look at this limitation and decide whether that interest can be deducted or capitalized. So essentially, you meet that limitation before you can capitalize everything. It was a reverse earlier on. And the fun part, so the first part here, the EBITDA threshold is valid as of 2025. So when I say 2025, it is years beginning after December 31, 2024. So that's the key there, because if you're a fiscal year, that becomes really, really important. But then the other two, they're actually valid after December 31, 2025. So
Okay.
there's a discrepancy there, right? And so if you think
Hmm.
about it, the limitation goes up, but it comes with two new rules. But it gives you the timing to actually plan for it, right?
Yeah.
What can bring your interest up, limitation up, what could take it down, right? And of course, they're like, this was one of the big changes that affects my clients for sure. How about
Hmm.
you, Kristjan?
Yeah, especially in the real estate industry, I guess really any taxpayers with interest expense, if it is a medium or large size business, 163J is something pretty common to consider.
Exactly. All right. And what's the next one? It's bonus depreciation. That was a big one as well, isn't it, Kristjan?
That is right. So bonus depreciation essentially allows the taxpayer to claim an immediate deduction for part of the cost of a qualified fixed asset, rather than deducting depreciation over a number of years. So the concept is not new. It's been around since 2002. But over the years, the percentage of the asset cost that's immediately deductible has changed. And when TCJA was introduced, 100% bonus depreciation was one of the big changes that really saved money for corporate taxpayers or business taxpayers, being able to immediately deduct the entire cost of a fixed asset when it's acquired. So for a business that's acquiring these types of assets in the US, the deduction for bonus depreciation can generate immediate and quite substantial tax savings, and it may free up cash flow that otherwise would have gone to pay taxes. So this really opens up an opportunity to invest those tax savings and get some return on investment. Specifically, it's designed in a way that the tax savings could be used to purchase additional equipment that's also eligible for bonus.
So
So
let
the
me
tax
ask.
savings from this provision can really compound and can really accelerate the pace of growth of business in the US.
Okay, so let me ask you this then. So if I were to place an asset in 2024, an asset that's eligible for bonus depreciation, and an
Hmm.
asset that I will place in service in 2025, what is the difference in depreciation then? What laws will apply there?
Hmm. So under the Tax Cuts and Jobs Act, the deductible percentage for bonus depreciation has been decreasing since 2023. So it went from 100% as low as 40% by January 2025. So for that 2024 edition, it would be eligible for 60% bonus depreciation. And we might be considering leveraging Section 179, which is a similar provision allowing the cost of an asset to be immediately deducted. And we could play with electing bonus depreciation or 179 to maximize the deduction in 2024, potentially getting as high as 100% using 179. But after January 19th, 2025, with 100% bonus depreciation being reinstated, you have the opportunity to claim that 100% deduction without any of the limitations that might apply under 179.
Isn't that
I'll just highlight there is a short period between January 1st to January 18th, 2025, when bonus depreciation is set at 40%. So that 100% threshold, it's reinstated January 19th and later. So if anybody has acquired fixed assets during that time, you likely do still have an opportunity to look at Section 179 and see if you can get a 100% deduction, either using 179 or a combination of the two.
Isn't that wonderful? Like until last year, you would take less depreciation, but now you place an asset in service after January 19, 2025, and you get to take it all. So
Yeah.
all these capital incentive businesses, this is something to think about, like the planning opportunity to buy those fixed assets that could be eligible for bonus,
Mhm.
and you get to take it all. And by reducing your taxes, increasing your deduction, and there's more money in your pocket, which could be
Yeah.
reinvested again, isn't it?
Yeah.
And then you get more assets and then you get more depreciation, right?
I completely agree. I think that the time value of money benefit of this provision and of getting that large deduction up front, is really huge for taxpayers.
Amazing. So there's another provision that I love talking to my clients about, and I'm super excited for it. So we talked about assets that are eligible for bonus. Usually we would think about assets with less than a life of 20 years. But this provision has something new about the non-residential property. Portia, do you want to talk about that? You can see me smiling ear to ear because I like this.
So there is a new class of property that is eligible for 100% expensing, and it's called qualified production property. So as Savneet mentioned, bonus depreciation has historically applied to assets with a class life under 20 years, which has excluded most items of real property. So qualified production property includes domestic new factories, refineries, or buildings used in agriculture or chemical production that are involved in the substantial transformation of a tangible product. In addition, certain improvements to these facilities and certain other structures may be eligible for the 100% deduction. So, considering the dollar value that usually attaches to this type of asset, and considering the 39-year depreciation period that it would usually be recovered over, there's a massive opportunity here to get a immediate deduction for the entire cost instead of spreading it over 39 years. Um, so yeah, really nice expansion to the bonus depreciation provisions here, that should be very attractive for anybody who might be looking to expand their manufacturing or production capabilities in the US.
So remember I talked about that 15% tax rate that Trump talked about during his campaign. And so I
Mhm.
think this is his way of saying, hey, if you bring manufacturing to the US, then you get to take this bonus depreciation on a property, which is usually depreciable over 39 years. So it's essentially telling everybody, come to US, put your manufacturing plant in the US, and it gives you that dates too. I think it's probably, you have to place it in service in a certain period of time. You need to start building during certain period of time, and then you get to take this. So it's actually telling everybody, come to the US. And anybody who comes to the US will get this bonus depreciation. And it could be a big amount, especially if it's buildings. Usually
Mhm.
you tie up a lot of money, like millions of dollars in a manufacturing plant, right? And so it could give you a good benefit there, right?
Mm-hmm.
The other thing that I did want to specify is the substantial transformation. So it's not enough to assemble. There has to be a substantial transformation of a product for that building, and the building has to be a production facility for to be eligible for this bonus. So Kristjan, if
Mm-hmm.
there's in this building there I'm producing stuff, if there's a space allocated for, say, a lunchroom, right, or office spaces for people to sit in,
Mm-hmm.
that whole building qualify for this bonus depreciation?
No, so you may need to look into a segregation study to see which parts of the building are qualified production property. And some portions of the building used for something like an office space may not meet that definition. But we can look if bonus depreciation or 179 expensing is available for any components that are not considered qualified production property.
Yeah, so something to think about, plan about, especially if you're looking to reduce your taxes down in the US and if you're trying to move your manufacturing to the US as then. Okay, so the next big change is the R&E expenses, so the research and experimentation. So let's talk about the prior law for a little bit here. So after 2021, US businesses were required to capitalize the R&D expenses and then ratably amortize them over 5 years. So you would instead of expensing it, you would capitalize it, amortize over 5 years for US businesses, but 15 years for anything else for R&D performed outside the US. So if you were doing R&D in Canada, but the expenses were related to a US business, you could amortize it over 15 years, but that hasn't changed. The 15-year rule hasn't changed, but what this act has done is change the rule for R&D for US. So instead of ratably amortizing it over a 5-year period, it gives you options now. So first of all, it says you no longer have to capitalize it. You have 3 options. And this is, by the way, it is eligible after December 31, 2024. And the 3 options are you deduct R&D right away, so you get expense at all. Or you can just keep going. You like the 5-year, you keep going, you amortize it over 5 years. And the third one is you can elect to capitalize and recover over 10 years. So now you have 3 options. You deduct it right away, amortize it over 5 years, or amortize it over 10 years under Section 59E. That's actually great because there were a lot of people who were in the research, who did a lot of research, and their money was getting caught up because they were paying taxes because they had to amortize this R&E. So this, I think, is a very, very big change, and it's an important change. And again, the theme is bring your R&D to the US and you get a lot more deductions, right? And again, one might ask if you have a client, right, who capitalizes R&D between 2022 and 2024, what should they do now? Because now you already amortize your R&D for a certain number of years, right? And so what do I do now, right? Do I get to keep doing that? Do I keep amortizing it? Or now is there a method change? So the new law actually states that there's actually a catch-up relief. And so what it says is you could actually deduct that that expense that you were amortizing. So say you, out of the 5 years, you amortize 3 years and there are 2 years left to it. You can choose to actually deduct it in 1 year or 2 years. And it's up, which is a great change, right? So if you've amortized for 3 years, you get those 2 years worth of amortization in 2025, which is awesome. Or you can just keep it going and spread it over 2 years. But the most important part here is the small business taxpayers. What are the small business taxpayer? It's a taxpayer with an average gross receipts of over 31 million or less in the last 3 years. And why is this important? If you meet that threshold, you could actually go back to 2021, right? Sorry, after 2021. So 2022, amend your returns and actually take that deduction right away. So all the taxes you've paid, you could actually get a part of it back, right? Which is amazing, isn't it, Kristjan? Like you get these deductions, right?
Yeah, so a nice change in the law and some nice options provided to taxpayers to get a retroactive benefit for this change.
Right. So the important thing to note here, though, so when I talk about going in amended returns or changing an accounting method to deduct it in the current year, you need to adhere to a timeline. So you have to take some of these elections and you have to file them within 1 year of the enactment of OBA, which is July 4th. So you have until July 4, 2026 to actually figure out if you want to go back, amend your returns or change your accounting method. So remember that 1 year period is super important. So I think plan for it now and see if you can get some of your money back.
Hmm. Savneet, do you anticipate any changes in the way that this is accounted for on clients' financial statements?
Um, yes, I would think so, right? So when you calculate your deferred taxes on your financials, you anticipate how much of a deduction you would get over time. And so if you were going to change, you were going to amend your returns, that changes that amount, right? And another thing that we would talk about is it's not only this R&D change, but all the other changes. What does it mean for your financial statements? Because you technically have to account for this in the year when this law was enacted, the OBA law was enacted. So when you're looking at your deferreds, you technically have to think about all these changes now, right? So
Hmm.
yeah, we have less time before the end of the year to get our financials done. So
Hmm.
yeah.
So there are a couple more changes in the One Big Beautiful Bill that we want to highlight for businesses. So one of them pertains to charitable contributions made by corporations. And there is a new 1% of taxable income floor for these expenses to be deductible. In addition, the 10% taxable income limit that has previously applied to corporations continues to be in effect. So essentially, now when a corporation makes a charitable contribution, the portion that's deductible for tax purposes is that portion between 1% and 10% of taxable income. And again, similar to the R&D expenses, we do expect to see some changes in how this is accounted for on tax provisions, because some contributions that were previously deferred into the future may now be a permanent add back.
So when you think about financial reporting and you think about deferreds, those all mostly relate to your temporary differences. And what I'm understanding here, Kristjan, and maybe you can explain it more, is you could switch between a permanent adjustment for charitable contribution versus a temporary adjustment, don't you? Right? Because if you look at the 1% floor, so if your charitable contributions are limited, are less than 1% of your taxable income, again, it's the taxable income, it's not your book income. It's something that you cannot figure out when you're actually making the contribution. You can estimate it. So if it's less than 1% of your taxable income, then you don't get the charitable contribution deduction at all. So it becomes a permanent adjustment, right? But whereas if it exceeds that 1%, but it's limited to that 10%, you get to carry it over for 5 years. So that's a temporary adjustment, right? You could get that deduction in the future. So it's an
Mhm.
important part, an important, I would say, a part of the law. And people should start evaluating how much they are putting, they are setting aside money for charitable contributions. And this could be a planning opportunity as well, just to make sure you get that deduction, right?
Mhm.
Okay.
So a little bit more complexity now on what's permanently disallowed and what's eligible to be carried forward.
Yeah, yeah, exactly.
So the next change that we wanted to highlight is the reporting requirements for some payments disclosed on Form 1099. So the 1099 is an informational form. I kind of think of this as the US equivalent of a T3, T5, T4A slip that we would receive in Canada when we receive certain investment income or income from services. So if you make these types of payments to US recipients, you may be required to file a 1099. And that requirement depends on the amount and the type of payment made, as well as the person who received the payment. So what's new here is that many of the payments that were reported on Form 1099 MISC have an increased threshold before the report is required. So in previous years, up to and including 2025, the threshold was $600 for a lot of payments made to for non-employee compensation, such as a payment to a contractor. So that $600 is being increased to $2,000 starting in 2026. And the increased threshold also applies to the requirement to do backup withholding. And the higher threshold will also be indexed annually for inflation. So this should be welcome news for taxpayers who make this type of payment, particularly if it's less than $2,000. You could see some relief in the filing requirements that you need to handle starting 2026.
Isn't that amazing? So less administrative burden, because that's a big difference, right? From $600 to $2,000, and it's going to get inflation indexed, which is amazing.
Yeah. It can definitely be an administrative burden to track the information and have these forms prepared. So I definitely hope that the higher threshold will reduce compliance costs for taxpayers who are making smaller dollar amounts for these types of payments.
So in the interest of time, I'm going to move forward, but maybe during our polling question, which is coming up next, we can talk about the qualified opportunity zones.
Sounds good.
So here's our polling question number 1. So which provision in the one big beautiful bill do you think will be the most impactful to your business and your clients? A, reinstating 100% bonus depreciation. B, increasing the limitation of interest deduction from EBIT to EBITDA. C, deduction of R&E expenses instead of amortizing them over 5 years, or increased threshold for 1099 reporting. So I'll give you guys about a minute to get through this polling question, but we'll take this opportunity, Kristjan, to talk about the qualified opportunity zone on the previous slide. Go ahead.
Absolutely. So the Qualified Opportunity Zone was an interesting new provision from the TCJA. So they designated certain census areas throughout the US as a zone to attract more business investment. And now the Big Beautiful Bill has created a new round of opportunity zone opportunities for investments made after 2026 and before 2034. So the states will be able to provide new opportunity zone designations for investments made during this time frame. And essentially, the benefit of these zones is that a taxpayer can defer recognition of a capital gain by reinvesting the gain proceeds into a qualified opportunity fund. And so the gain can be deferred under the Big Beautiful Bill up until 2023. And in addition, a basis step up may be available if you hold this qualified opportunity investment for a period of at least 10 years. So even though your initial gain will be recognized after 2023, you could have a permanent deferral of any appreciation after you invested into the zone.
That's amazing. So going back to our polling question, most 59% have actually answered A, reinstating the bonus depreciation. 31% also talk about the EBITDA, the 163J, which is amazing. It's wonderful. There's no right answer here. It just depends on your business, your clients, etc. So moving on. So next we have here is, this is a BizTax seminar. So we are not going to do a deep dive into the key changes for individuals, but at the end of the day, it's the individuals who own the businesses. So you not only have to worry about how much tax the business is paying, it's also the individual or the owner that's paying, right? So Kristjan, why don't you talk about some of the key changes for the individuals? And again, we can't spend a lot of time here. We'll probably have a different webinar, an in-depth webinar on individuals at a later stage, but we want to touch upon these because these are important enough.
So just briefly, the lower income tax rates introduced by the TCJA have now been made permanent by the Big Beautiful Bill. So the individual tax rate in every bracket is lower than what it was before 2018. The higher standard deduction provided by the TCJA has now been permanently extended as well. So the standard deduction will be 31,500 for a joint return and 15,750 for single filers. The limitation on individual deductions for state and local taxes has been increased from $10,000 to 40,000 for 2025 and 2026. Although after 2029, it will revert back to $10,000. Miscellaneous itemized deductions subject to the 2% of taxable income floor were suspended under TCJA, and that suspension has been maintained under the Big Beautiful Bill. And the elimination of personal exemptions has been continued.
Got it. So I think one other big change is the QBI. It's again another acronym, Qualified Business Income, or the Section 199A deduction, right? So this was a temporary deduction again, and now the OBA Act actually has made it permanent. So it was set to expire. So essentially, this was brought on by the TCJA, and if OBA didn't address this would go away completely. So this was important that this was made permanent. But what is this QBI deduction? So essentially, back in the day, the corporate tax rate, it was a slab rate, and also the highest rate for corporations was 35%. So over the years, the tax rate went down to like 21% for corporations. So however, for an individual who owned investments through a pass-through entity, they were paying way more tax because the individual tax rate, the highest is at 37%. So this was a way to give deductions to those individuals who held investments through a pass-through entity. And you would take 25%, you would take 20% of the qualified business income and take that as a deduction. Again, we don't have time to get into the details of what a QBI is, but that's an important deduction. And I'm glad they made it permanent. And it's important just to maintain that balance between how much tax an individual pays versus a corporation pays.
So corporations will continue to benefit from that lower 21% tax rate, and now individuals can permanently rely on these QBI provisions to get a similar effective rate.
Right, they're trying to get to a place where everybody pays the same amount of tax. And remember, when a corporation pays dividends up to the owner, they pay additional tax, right? They're trying to equate it so that the vehicles, like the businesses versus investing through a pass-through entity, have about a similar tax effect.
Awesome. So I'll move on now to discuss the qualified small business stock provisions. This is another one that's not brand new, but has been modified under the Big Beautiful Bill. So essentially, this provision allows a taxpayer to exclude up to 100% of the gain from taxation on the sale of a qualified small business stock by a non-corporate taxpayer. So before the Big Beautiful Bill, there was a few requirements that had to be met to be eligible for this gain exclusion. The stock had to be in a qualified small business, meaning that the aggregate gross assets were less than $50 million immediately after the stock was issued. However, that cap has now been increased to $75 million under the Big Beautiful Bill. It needs to be stock that's issued directly by the corporation, so you can't purchase it secondhand from another investor. There is an active business requirement, so at least 80% of the value of the corporation's assets need to be used in an active qualified trader business. So certain service and professional businesses are excluded. Previously, you had to hold the stock for at least 5 years to qualify for this exclusion, and this is one of the major changes under the Big Beautiful Bill. There's still a 5-year period to get the 100% exclusion, but there's now a tiered structure where you can get a 50% exclusion of the gain if you held the stock for at least 3 years, and a 75% exclusion if you held it for at least 4 years. And it continues to offer the 100% exclusion for a holding period of 5 years or more. So that introduces some really nice flexibility for taxpayers that hold this type of stock for less than 5 years. You can still exclude some of the gain.
Isn't that amazing? Like if you're a Canadian who wants to invest down south in the US, and like this could be really useful, right? If you're trying to expand down in the US by an acquisition, it could be really big, right?
Yeah. And again, the maximum gain that can be excluded is 15 million under the new legislation, or 10 times the basis of the stock, whichever is less. So it's potentially a very large dollar item.
Yes, absolutely. And I think the other big change that we think about here for individuals is the estate and gift tax exemption. So before TCJA, this exemption was 5 million. TCJA doubled it up and said 2018 onwards, this gift tax exemption or estate and gift tax exemption is essentially 10 million, and it's going to be indexed to inflation. So, but then again, TCJA, like everything, a lot of them, it was temporary. And so if the OBA Act didn't address it, you would go back to that 5 million threshold. That's a big change, right? So now you are looking at a 13.99, which is the 13.99 is the 10 million index for inflation for 2025, right? So in 2025, you're looking at 13.99 million gift tax exemption, estate and gift tax exemption, but then come 2026, if OBA didn't didn't address this, it would go back to 5 million, which is crazy. So what does OBA do? It made this amount, the 13.10 million to 15 million. So now, and it made it permanent. So you don't even have to worry about it's ever going to go back to that 5 million. So you get a 15 million estate and gift tax exemption, which is great and which is pretty big. Right?
So the estate and gift tax applies to US citizens and to foreign individuals that hold US situs assets. So I know I had a shareholder of one of my corporate clients who was a Canadian that held some US situs assets. And they were really concerned about decreasing the value of their estate before the estate tax eventually kicked in. I think with this higher exemption amount, it's something that a lot fewer people will need to worry about.
Absolutely. And then it also extends, there's a permanent extension of the excess business loss limitation. In the interest of time, we're going to skip that and go to our next polling question here. Oh. Let's see. There you go.
Okay, so under the One Big Beautiful Bill Act, what is the federal estate and gift tax exemption amount effective January 1, 2026?
That's
Either
an easy
15,
question. I just thought
25,
about this.
40, or 30 million.
That should be really easy. Hey, we just talked about it. It's wonderful.
See who is paying attention.
Definitely. So then just thinking about this One Big Beautiful Act, and I just go back to the July 2nd, right? This is just 2 days prior to when the act passed, right? Or the act became a law, essentially. And then I'm sitting there at midnight. There are more nays to yeses for the bill. And I'm like, this is no way it's going to pass, right? There are 9 more votes to go, but then the yeses are way lesser. So either they have to turn the nays to yeses overnight, and I'm like, not going to happen at all. It's done. So I go to bed at midnight, and I get up in the morning. Guess what has happened? So the marathon went on overnight. They did convert the nays to yeses. So yeses, and then they actually got the bill passed, which is crazy. And I was like, okay, it's not going to happen, but they were so close.
Mm-hmm.
Well, looks like a lot of people are paying attention. A is the right answer, and 85% of you got it right, which is amazing. Okay, so moving on. All right. So I think this is one of the most important feature changes as a result of OBA. So Kristjan, why don't you talk a little bit about the GILTI, more acronyms, by the way, GILTI and FDII.
Mm-hmm. So GILTI was also introduced by the Tax Cuts and Jobs Act in 2017. It was essentially meant to prevent a US business from shifting their profits into a low tax country by setting up a foreign subsidiary and moving some of their income generating intangible property overseas. So to the extent that these foreign subsidiaries generated deemed intangible income, it had to be taxed in the hands of the US owner on a current basis when the corporation earned it. So that US shareholder didn't need to wait to receive a dividend before the income was subject to tax on their return. And to measure the deemed intangible income, we actually had a deemed return on tangible assets. So there was just an assumption that all of your tangible assets in this foreign sub would generate a 10% ROI. And then any profits in excess of that was deemed to be intangible and was subject to this GILTI taxation regime.
Which is, if you think about it, they figured out a formula to figure out how much of your income is related to foreign assets and the rest is intangible. So you bring that in and the US tax shareholder gets taxed on it. And I think that explains it all because they took away the NDTR or the net deemed tangible income there, which basically was based on your qualified assets. And that's why the name changed, right? So global intangible low tax income is now called the net CFC tested income.
Mhm.
Essentially, they've removed that deduction which related to the fixed assets. So now you actually have to take that and you'll be taxed on more of your income. So as a US shareholder, you'll get taxed on more of what your CFC or your controlled foreign corporation's earning, which is a big change. But then the other big change is the effective tax rate. Kristjan, do you want to talk about that?
Sure. So in addition to subjecting this GILTI income to tax, there was a deduction provided by Section 250, which allowed you to deduct 50% of your GILTI income, and you're essentially subject to tax on half of it. So for a US corporate shareholder that pays a 21% rate, the effective US tax rate on GILTI was half of that, so 10.5%. However, the TCJA had a sunset provision. So the 250 deduction was set to decrease. And the big beautiful bill has increased it slightly. So if you want to flip to the next slide, I'll quickly show a comparison of the rates. So the 250 deduction in the second row here was 50%. It was set to decrease to 37.5 and now has been permanently set at 40%. So the effective tax rate on your net CFC tested income will be 12.6%. You are also allowed to claim a foreign tax credit. It was previously for 80% of the foreign taxes paid by the CFC. So in many cases, if the foreign subsidiary is paying a high enough rate of tax in their foreign country, then these provisions may be sufficient to eliminate US tax on your CFC net tested income.
Got it. That's very interesting. So there's GILTI, which is now called net CFC tested income, and now there's FDII, which is foreign derived intangible income. How's that changed, Kristjan?
So FDII, I almost think of it like the inverse to GILTI. So this is an incentive which encourages US corporations to keep their intellectual property in the US and to make exports abroad. So the FDII provisions provide a reduced effective rate of tax on income earned from exporting goods, services, or intangibles to foreign customers. So previously, only the portion of profits that exceeded a 10% return on tangible property was eligible for the FDII deduction. Um, so if you flip down to the next slide, there are also changes in the rate of deduction offered on FDII income. So it was a 37.5% deduction previously. With the TCJA sunset provisions, it was set to decrease to 21%. But with the One Big Beautiful Bill, it has been set at 33%. So now the effective tax rate on FDII eligible income is 14%.
So in the interest of time, Kristjan, I'm going to flip to the next polling question, but we're going to come back. I want to make sure we get all the three polling questions in.
Great.
So the next polling question is, what is not true about the changes made to GILTI as a part of the One Big Beautiful Act? A, GILTI has been renamed to Net CFC Tested Income. B, Net Deemed Tangible Income Return has been removed from the calculation. The effective tax rate of 13.125% beginning in 2026, or the effective tax rate of 13.125% beginning in 2025. Maybe a trick question there, right? While we look at this, I think I'm going to flip back. While you answer this question, I want to flip back a little bit and go back here and talk about BEAT, so another acronym. So essentially, what is BEAT? It stands for Base Erosion Anti-Abuse Tax. And this is very important for large corporations, and it applies to corporations that have gross receipts of an average of 500 million over the last 3 years. So it's a big number. It's an additional tax, but for larger corporations. And the reason I want to talk to you about this is because they were going to change that, which was crazy, because the Section 899, and you all must have heard about it, right? So that was treated as the revenge tax, essentially, and it didn't leave it only to the big, large corporations with that kind of income. It pulled in a lot of other people, a lot of other corporations also, especially Canadian. And so they changed they were going to change the definition of applicable corporations, and which would pull in a lot more people, like a lot more corporations in Canada. And if you think about it, that was a big, big change. And thank God they took it away, which was amazing. And this tax would then apply to corporations in Canada, but there were two kinds of taxes there. One was the increase in, say, withholding taxes. So, for example, if a US corporation paid interest to a Canadian corporation, there is 0% withholding tax. That's under the treaty, right? But then what this would do is, if this applied to you, that tax rate would go up by 5% every year for 4 years. So if you were looking at paying a withholding tax of 0, and now you have to pay 20% tax, that would decrease your profits quite a bit, right?
Mhm.
And this not only applied to withholding taxes, it would apply to FERPTA, it would apply to your effectively connected income in the US. So it could change a lot, right? And this applied to countries that they said they were discriminating against the US, and that would include countries like Canada, which had taxes like DST, the digital service tax. And so if you realize, I don't know if you realize that, but after G7, right after G7, Section 899 got taken away after Canada canceled the DST plans,
Mhm.
which was very interesting to me. So I'm glad there's no more Section 899, and the BEAT doesn't apply, or the Section 899 doesn't apply to the larger population, because that would change a lot of tax. There'd be a lot of money out of your pockets if that applied, and we were all watching it very, very closely. Super important. Okay. Going back to our polling question there. The right answer is C, which is effective tax rate of 13.125% beginning in 2026. Okay. All right, let's keep moving on to our timing and method of recognition. Kristjan, do you want to talk a little bit about this?
Sure. So ASC 740 governs the accounting rules for income tax, both for current and deferred tax. And it provides that when the tax law or the tax rate changes, the impact on deferred taxes needs to be recognized in the period of enactment. So for any corporations that have a fiscal year including July 4th, 2025, then that's the period that you'll want to account for the impact on deferred taxes of these changes. So as we head into the end of 2025, as we head into any fiscal years that are closing, and we head into provision season, calculating the tax provisions, we'll need to plan some additional time to consider the impact of these rules on the financial statements.
Absolutely. I think that's going to be a big change for us, is figuring out how this affects our taxes and especially deferred taxes, right? There's some things that we did want to talk about here, and it's more of a question for CFOs or business owners out there. Have you thought about modeling all these changes? How does it affect you, right? This could be a big change. And we talked about a lot of stuff today. We talked about BEAT, GILTI, FDII, all those acronyms and difficult concepts, but then they all have an interaction with how much is your NOL and how much is your 163J deduction, which is your interest deduction, right? So there's an interplay between that. So what could be a good answer for one business will not be a good answer for the other. So it's super important that you model it out. So I want you to think about that and see if you need help with it, right? Because this is an important feature. So for example, the R&D, whether you want to deduct all the R&D right away, or do you want to amortize it over 5 or 10 years, that's a big decision. Because guess what? When you take all these deductions, your BEAT liability or that additional tax for larger corporations that I was talking about might just go up, right? So there is a balance that you have to maintain, and it's so important to model all those out, right? And Kristjan, and you and I were talking about this. The big thing is nobody's looking at the state taxes here. How do you think it's going to be so difficult? So do you want to talk a little bit about that?
Sure. So I guess the states sometimes conform with federal laws, and sometimes they have a departure from federal tax law. So when we talk about all of these changes from a federal perspective, there's kind of another side of the coin that we should consider how this impacts the inclusion of income or the deduction of expenses at the state level. And one area that's really important to consider, if it's relevant for you, would be GILTI. Because some of the states include GILTI and income, some of them provide an exemption of it. But essentially, given the changes in federal law regarding the Section 250 deduction, um, it could really cause an increase in state tax expenses, particularly if you see an expansion of the pool of income that's included in GILTI, maybe without an exclusion at the state level. And without a change to the Section 250 deduction, it could really increase the amount subject to state tax.
I just want to, so we're just right, there are 2 minutes to the hour. So I want to make sure we answer any questions. I haven't seen any questions come through from you, but do put it in. And please be aware that there'll be more webcasts coming through, which will talk about all that we talked about today and more in detail. So this was mainly to give you an overview. And so we want to make sure that you have all the knowledge. You might not understand it fully, or even us, right? We're still waiting for a lot of legislations to come through that explain it, or the regulations to come through that would explain how each of this would be enacted and what it would look like. So watch out for those webcasts, but I do want to give you guys an opportunity to ask those questions. I haven't seen any come through. But the other important thing that I did want to talk about that, because of the lack of time, was one was the hot potato rule. So it's very funny. Like the hot potato rule is nothing but, so whoever was holding that control foreign corporation at the end of the year gets to pay tax on the sub F, which is an equivalent of FAPI and GILTI were related to that corporation. So everybody would pass it around, and whoever held it at the end of the year actually gets to pay tax on it. So it was a big part when you were buying and selling businesses. But now they fixed that. So you have to include the pro rata share of the income into your taxable income for that year. So you can no longer pass it around, which is great. And then the other things that we'll talk about in the future is the restoration of 958B4, which is an important one, especially if you file 5471s and the big penalty related to it. Alrighty, I think we are at the top of the hour now. I'm gonna flip to the next slide, which is our QR codes. So if you're anything like us and love technology and don't like to save business cards, so just scan this QR code and it'll give you our email IDs as well as our LinkedIn profile. So do add us on LinkedIn and look out for all those new webinars. We'll keep posting. Thank you and have a wonderful day.
Thank you so much.